Okay, guys, welcome back to Basics episode 15, where I'm taking my lovely fiance Jessica and teaching her to trade. If you're new here, we have a playlist. You can go on either of our channels and just watch 1 to 14. Also, if you're seeing this on my channel, Jessica's will have the next episode out. Last week we covered triangles, all about triangles.
I think so.
Good, because next time there'll be a test that will have this and triangles and channels all on them. So get ready for that.
Get ready for that.
Get ready. It's going to be a hard one. Okay, so here is our social medias. Go follow us on all of these things. For me, it will be about trades that I'm going to take, algorithms that I'm working on, things like this. And for Jess, she's going to document this whole journey of learning into sim trading, into real life trading, and that journey there. So triangles we talked about. So you remember all these?
I think so. Yeah.
You remember where I disagree with these pictures?
Vaguely.
Which two do I trade opposite from conventional wisdom?
The ascending and descending.
And why?
I don't remember.
Basically because there's been a bunch of studies done on them that show that they work more often and better from a risk-reward standpoint the other way. I follow the math. So this is into flags and pennants, which is kind of a next step in. So when we did these, you talked about how you didn't really know from the pattern what happened before. You said, well, how do I know if it's a bullish or a bearish chart? Mm-hmm. And that's because we're focusing on just that individual pattern. But you're right that the pattern that precedes it is going to give us kind of an overall indication of which way to trade, right? Because we're always trading with the trend. So this type of setup, we would hope that it's kind of in the light of an overall uptrend, right? Whereas this one here is in the light of an overall downtrend. So before these patterns started to form, the stock moved down. So if we zoom out on this, basically these triangles and channels turn into flags and pennants. They're patterns that include all of the other action before it. So here's a bull flag and a bear flag. And you can kind of see, if you take the bull flag and just turn it a little bit, you can kind of see where it got its name. It looks like a flag. Mm-hmm. You've got the flagpole pushing up, and then you've got some sideways action and some continuation. Basically, we know price can't just go up forever. At some point, if you buy a stock and it's $1 and it gets to $10, there's going to be a group of people that are like, okay, that's a huge return, I'm going to take my money. So there's always going to be a point where a stock stops and works through the people that are trying to sell. And it can do that through one of two ways. One is those people that are selling can push the price back down, assuming that there's no other buyers in there. Or two, you get these congestion zones. So it can either resolve through price or it can resolve through time.
Okay.
That makes sense?
I think so.
Right? So if you bought a stock at $5,
right,
and you woke up the next day and it was at $10,
right,
you're probably going to sell.
Okay.
Right? So if everybody does that, you're probably going to sell. Then if enough people sell, then the price is just going to crash back down. But if enough people are selling, and then every time that they sell, a buyer comes in to hold the price up, then you're going to get these congestion patterns, right? You're going to sell, but then there's going to be someone there waiting to buy. They're going to push it back up. Just like how we talked about how that creates a channel, but now we're just saying that this channel occurs directly after an up move. So just think about it in kind of a zoomed in way. If you were to take this part of the pattern here and just look at that without looking at anything else, it's just a downtrend channel. It means that sellers think that when it's at the top of the channel, it's too high and it pushes down, then there's buyers, right? And vice versa. But again, this is just kind of taped to the top of an already existing up move. So we know if we zoom out that the buyers are in control. And then if we zoom into the actual channel, then we know that there's that battle going on between the support and the resistance area.
Okay.
Right? So that's a bull flag, basically. And generally speaking, the way to trade them is you buy as it breaks out of the channel, Your stop is either if it gets back in the channel or if it breaks below the channel, if you want a wider stop. And then your profit target is the width of the channel.
Okay.
Right? And vice versa for the downside. Okay, so here is a real world example of a flag of a trade that I took recently. So you can see, I drew it out for you, but you can see how kind of this thing would look like in the real world. You had a big strong push up here, a bit of a sideways move as it kind of drifted lower and created this little channel where it bounced around. And then you can see what happens after it broke out. So again, there's two ways mainly to measure your profit target. One is the width of the channel, and then the other is how long what they call the flagpole is. So from where it kind of broke out or started on your chart to where it ends. And then you could take that line in Trade Ideas and just copy it up and say, that's what I expect my target to be on this trade. So now you're risking, right, this tiny amount, call it 50 cents to make, almost $5, right? That's 10 to 1 risk reward. So it means if you're right 10% of the time, you break even, which is great. And then here is another one that actually I did this a few days ago. This actually turned out into a nice trade from something that I found. Again, you can see the move up from the last little kind of base that it was in, and then this kind of sideways pull back, and then it kind of broke out there, had a little one candle breakout.
So why are we saying that this is a flag instead of just a channel?
Well, again, it's a flag. It would be a channel if you only zoomed into that channel part.
Okay, so you can't have a flag without a channel.
No, and we'll show there's another type of flag, the Pennant, which we'll show in a second. But yeah, it's essentially the same pattern. It's just, again, we're looking at time frames.
Okay, so you can't have a pennant without a triangle.
Right.
Okay.
Right. So it's just, again, it's to bring up what you talked about in the last episode where you're like, okay, how do I know which direction to trade these in?
Yeah.
Well, the channel and the triangle was to show you to trade in this overall trend. And when you put the trend and the pattern together, this is the pattern you get. So a pennant is the same type of thing, except instead of a parallel channel, you've got a more triangular channel, right? So you can see, this is the next evolution from what we did last time, where I think a human being could just sit and trade this particular pattern, both long and short, and have that be it. And, learn it and master it and kind of go from there. It's a very simple pattern. Again, the rules are stated for you. You would buy on a breakout of the triangle. If it got below the lower end of this triangle, you're wrong. And then you measure kind of the flagpole up and you say, that's my price target. All kind of stated for you right there. Then here's one, again, in the real world, right? You had a big push up, and then you have these kind of tightening channel lines in. So your target or your buy here would be just above this line. So call it $19, and you'd risk $1, and you look to make 4. So 4 to 1 risk reward. If you're right 25% of the time, you make money. So wedges. Again, this is a longer type of example than the other one. So everything we've done so far has been some sort of trend following pattern. Some people don't like trend following, and although I recommend it highly, this is going to be your journey. You can trade however you like. A wedge is essentially looking at these. This is the first of the reversal patterns, and what we'll go through after our test is a whole slew of reversal patterns, which again, time frame dependent, you could trade with a trend as well. You could look for...
What do you mean reversal pattern?
Whereas, so you can see a flag here. They call these a continuation pattern, because you're looking, the price is moving in a direction, you're looking for it to pause, and then you're going to trade it in whatever that original direction was.
Okay.
A reversal pattern is saying, I think that this is the top, and I'm going to trade this the other way.
Okay.
What the stats show with trading reversal patterns versus trend continuation is trend continuation, you are right far less often than reversal trades. However, you make way more when you're right than you lose when you're wrong.
Okay.
Whereas trading reversal patterns, or people call it revision to the mean, where if they think a stock's gotten too high, they look for it to come down. If they think it's gotten too low, they look for it to go up. You're right more often, but there's less of that outsized return.
Okay.
Makes sense? So again, this is the first one. And what do you think kind of this means from a psychological point of view? Remember, there's nothing magic to these patterns at all. They all just represent this psychology of the buyers and sellers.
I don't know. I don't know what you mean.
Well, just look at the pattern and just kind of think of what the buyers are doing and what the sellers are doing and kind of what this could represent in the grand scheme of like, you know, this continuous war that we talk about.
They're pushing the price higher and higher.
Right, but but it's in a declining way. If you were to draw a line to connect under these under these lows, you can see that would be kind of the slope of price. And as that slope of price starts to turn, where you can see you have a more flat horizontal line here, it's kind of just showing that they're running out of steam, right? They're not pushing it up with as much force as they were before. Price is still moving higher, but it's moving higher as it's coiling over and as it's tightening up. Does that make sense?
I think so.
Just take my word for it, right? It's right, each high as this line slopes, it's just saying that it's no longer has the power that it had before. And as this becomes tighter and tighter, it kind of just shows that these buyers are running out of steam. They can't push it, even though they're pushing it higher, they can't push it higher at the rate that they normally could have.
And what's the difference between this and a sideways channel?
Well, a sideways channel is that you can see these lines are converging. Whereas a sideways channel, they're parallel. So when they're parallel, it means that there's an upper and lower bound that they just keep fighting against.
Okay.
When the prices or when the lines are converging, it just kind of means that both sides are weakening as things go, right? They can't push it all the way down to what would make a parallel channel, and they can't push it all the way up to what would make a parallel channel, right? Every time these sellers push it down, they can't push it down quite as low, but every time the buyers push it back up, they're not pushing it up at a rate like they did here, right? You see how they were able to push up these two big candles here, but then if we fast forward over to here, they can only push it up these two little candles here, right? So they're just running out of steam. So then this is kind of the first reversal pattern, because what a lot of people would do with these wedges and say, okay, now that I've drawn these lines, I'm going to wait, and when I get confirmation that the buyers indeed have run out of steam, I'm going to take the other side. Because if you're buying through here and you're always buying every time this channel hits and you're making less and less money every time, then what you're probably going to do when this pattern finally breaks is just get out. And by getting out, it means you take short. And then here's one in the real world, but from the long side. So you can see this stock is hammered, right? $150 down to $13. So, it's an oil stock, which is why that happened in this market. But you can see every time the sellers come in to push it down, even though they're making new lows, on a relative basis, they have less power every time. So the game plan would be for here is if this breaks above this downtrend channel, you would buy it, your stop would go below, and your target is the width of the initial move, right? So that would get us from here from $13 up to like $50. That's the premise of counter trend trading, or revision to the mean trading, or trading reversals. They all mean the same thing. Is basically you look at something and you say, okay, it's obvious who won here, right? Short sellers obviously won if you look at this chart, right? From $150 down to $13. If you're short, you're happy. Well, the only way you can turn that trade into money and put that money in your pocket and go buy something with it is to buy back those stocks. So they're trying to time the moment at which they think everyone's going to take their profits, and then they get their little piece of the pie. Same as if this was the other way around, if the stock went from 13 to 150, right, there, you know that there's going to be a whole bunch of people who are going to want to take that profit, turn it into actual money, and go buy something with it, right? So you're just trying to time that moment where the current shifts. And again, the benefit is you'll be right more often, just because things are generally more choppy than they are trending. But you're not going to make 20, 30 times your money as you would on the other ones.
Or am I?
Maybe you'll be the best counter trend trader of all time, but that's just how the statistics kind of line up when they come to those things. So here we are. Again, if you guys are enjoying this, let us know. Feedback's welcome in the comment section. And if you're seeing on her channel, come to mine. If you're seeing it on my channel, go check out hers. Any questions?
Nope.
All right. Goodbye.